Borrowers can also further reduce their monthly payment. And I'm putting a plug for our bank in here because our first liens, we offer up to a 30-year term, where most banks are 20, 25 years. So that's another way to even lower your payment further on the first lien with a 30-year term.
Yeah, anytime you can amortize over a longer period, reduce your payment, your monthly payment. It's kind of a thing we look at all the time in commercial real estate. It's a 20-year AM versus a 30-year AM. Even if the 30-year AM's got a little bit higher interest rate, it's still usually a better investment model, like what I'm looking at, because you're getting a better cash flow.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Beau Eckstein.
Hello and welcome back to another show, and we've got our celebrity guest here today, our celebrity guest on SBA, anything to do with SBA financing. And today is specific to the refinance options available, which weren't available prior to about a few months ago. I forgot the exact date. We'll kind of dial in on that. But we have Carrie back with us, and we're going to talk about opportunistic time if you are in an SBA 7A loan and you have real estate with that, to refinance into a 504 loan. Because generally, the 7A loans are a variable rate, meaning they're based on a margin index, and they're usually somewhere in the sixes right now. And if you fit what we're going to talk about, you may want to reach out to us. There's be a calendar link below. You can set up a call. But this might be a good time to fix in your rate and potentially get cash out, I believe. And we're going to dive into those questions and answers, and not to mention that, but the fixed rate of the 504, the blended fixed rate, is far superior. So you might see a 2% drop in interest rate potentially, should be significant for you and your cash flow. So Carrie, without further ado, welcome back to the show. Let's dive into the 504 refinance program. Why don't we just start with the background of when this refinance was enabled, because prior to a few months ago, you weren't able to refinance a 7A into a 504, from my understanding. Can you kind of give us a little bit of background on this?
Going back, I think, to when the TARP loans or the TARP program was in place back in 2008. Somewhere after that, that's when the first refinances for 504 were allowed. And then later on, I can't recall the exact year, I think it was 2018, the refinance rules were made permanent, and they kind of split it up into two categories: with expansion, without expansion. And then this year, as of July 29th, some great improvements were made to the program where you could refinance existing government guaranteed debt like a 7A or even a 504. And then they also lowered the seasoning on the debt that could be refinanced from 2 years to 6 months. So some great benefits that were put in place on July 29th.
Okay, so let's kind of just walk through like an example case study that doesn't have to be real, of a, should we just use a doctor? He owns a building. He originally bought the building with a 7A. He's in the sixes right now on interest rate. The property's gone up in value a lot. The business is doing well. What are we looking for the refinance?
Okay, well, Beau, you said the key thing about the property going up in value, so that would mean he would have enough equity that he wouldn't have to come to closing with cash out of pocket. And normally with a doctor, as long as he has 10% equity, then we could proceed with the refinance. And as you mentioned also previously, if he's currently in a 7A loan, chances are it's variable and tied to prime. Usually doctors, they get a benefit on the rate. They're usually prime plus 1.5. But if he's happened to paying prime plus 2.75, which is the max margin for a 7A loan, then it would be very beneficial for him to consider a 504 refinance and get down to a blended rate of about 3.75% based on current rates. Say the building is, the loan balance is like $2 million. That could save upwards of $3,000 per month.
So it's got to be all hard assets with the 504. So if the borrower sponsor did like a business acquisition where when they purchased the business and the property, they were paying some for the actual blue sky, we can't use that. Now, if it was several years ago and the property's gone up in value, how are we going to look at this now? Are we going to we're going to look at the appraised value of the building and make sure that the income from the business covers it from a debt service standpoint? Is that kind of the general underlying? I know it's got to have a intrinsic benefit to the borrower, meaning a 10% or greater reduction in payment, not counting any cash out, because you can pull cash out, Carrie, correct? If there's enough equity?
You can only pull cash out if it's a non-expansion loan. And the cash out can only be used for eligible business expenses like rent, marketing, utilities. But it has to be non-expansion, meaning they don't have any, of course, major improvements to be made. Also, to touch upon what you just said, Beau, about a 10% improvement, that rule is true for 7A loans. Also, on top of that, the existing lender, 7A lender, has to be unwilling or unable to modify the loan terms. So a bank like ours would need something, either email with their signature or a letterhead, unable or unwilling to modify the terms of their current loan.
Are you looking for capital for your business? Whether you need to get new equipment, finance your accounts receivable, raise working capital, or acquire commercial real estate, SBA Exchange can help you get approved and funded. SBA programs can also fund ground-up construction projects. The process is simple, and the initial consultation is free. Simply book a call. An advisor will call you at your desired time. We have built relationships with the top SBA lenders. We know their lending appetite. We will source and connect you with the appropriate lender. You will not waste time trying to figure out who to apply with and how to get started, and follow the process through to completion. We have streamlined the lending process from A to Z and work with you on all forms and documents to expedite your loan approval. SBA Exchange is the marketplace for SBA financing.
Okay, yeah, and I'm assuming that they're not going to want to, right? They're like, well, why would we want to? We're making our margin on this. Why would we reduce it? They're probably not going to want to do that. They probably would rather get it paid off. Now, if they're in the deal for maybe, like say they're in their previous loan for 5 years and they have a 10-year prepaid, they're still going to have to pay the prepayment penalty, but we can finance that within the 504 refinance.
If the existing loan is a 504, it would be a 10-year prepay because, as you know, 7A would be 3 years.
Yes, that's correct. Okay.
But let's say it's a second year of a 7A. The balance of the prepay can be financed. You are correct.
Now, going back to the expansion part, will this refinance work for an expansion with no cash out, but just expansion, or this is strictly for refinance of debt with non-expansion?
Refinance of debt with non-expansion.
Okay. So, but that doesn't mean like if they were expanding that they could, there's no I guess, is there no product that works for a 7A expansion going into a 504? There
is, but okay. they couldn't get cash out though, is the only difference. Yep.
Yeah, okay, got it. So that's a separate kind of product. It's similar underwriting process. So the underwriting is generally the same as it would be for purchase with a 504. I mean, their underwriting debt service coverage ratio, what wouldn't be eligible at this time for this 504 refinance?
Well, as they say, cash flow is king. So if the property or if the business is currently not cash flowing, then that would be probably number one. If the value doesn't come in, as we discussed before, like the loan that you and I are doing now with the dentist, his value is just, that's still too high. I'm sorry, his is still too low for us to have 10% equity. So those are the two big ones: cash flow and the value of the property.
Is there any product that would hit, because this is an existing business, most of the time, assuming that the cash flow is there and the equity is there, we should be able to do a combined loan to value of 90%? Not right. Like, is there any type of business that would be limited to 85%?
A special use would be.
Special use would still be limited to 85%.
Yes.
And can you classify special use for us?
It's a property that would be difficult for a lender to sell if they have to take back because it's committed to one use, like a hotel or a bowling alley or a gas station. It's only limited to one use. Whereas like an office building or an industrial building, any number of different type of business types could actually buy that building and use that building.
What is I guess really, if anybody's listening to this that has a 7A that has enough equity without blue sky and it's real estate related, the asset has real estate, then it's most likely a candidate for this program.
Absolutely.
And there's certain lenders out there that are kind of usually the higher margin type 7A lenders, meaning they're usually at the maximum margin. So on a 7A loan, you have an index, which is the prime rate, right? We always, right now, and historically, I believe the 7A has been always tied to prime. And so, yeah, the prime rate plus your margin. So the margin is basically going to be anywhere. Where's the lowest margins you see on a 7A? 1.25?
So I've seen them as low as a half a point before. Yeah. And then, of course, the max is 2.75.
Most of the lenders seem to be in the twos, but
that's correct. Especially the ones that sell in the secondary market. They'll have a higher margin.
So like the non-bank 7A lenders are usually 2.75 margin.
Yes.
So basically a variable rate is always a margin plus index equals your current rate, right?
Correct.
And so prime rate's adjusting monthly. So if you're in this loan right now, let's say you're in 6 or 6.5, 6.25, what's going to happen to the prime rate? Over time, we're pretty low right now. So in theory, the prime rate would be probably going up sometime over the next couple of years, which means that your fully indexed rate's going up. So it's an opportune time to refinance into a fixed rate product. And on a 504, your senior loan, and you have your SBA or the CDC piece, which is the second. So it's 50% of the total loan is the bank loan. The 40% is the CDC portion. The CDC portion, once the debenture happens, becomes a 25-year fixed rate loan. Currently around 2.87 or 2.97 is the current rate there. And then your bank, that's going to make the interim loan, because the 504, the debenture happens after the transaction, the refinance happens, right? So it's still the same debenture process, Kerry?
Yes, if there's no construction involved and it's just straight refi or even for a purchase, the debentures usually fund once a month, but sometimes in the middle of the month. So to help expedite that process, as you mentioned, like our bank funds the permanent first lien and then a bridge loan or interim loan for the CDC piece. And then usually within 60 to 90 days after the close of the first two loans, the CDC will take us out.
And that's the same on a refinance like this. It's the same process. I mean, meaning it's going to be the bank funding loan 1 and 2, and then the debenture is going to happen on the refinance the same way it does on an acquisition.
Yes.
So it's exact same process. You still need a CDC involved on the refinance. It's a similar underwriting and timing process for the refinance.
Yes.
In theory.
Yeah.
It's a very similar process as an acquisition. You're going to have the bank involved. You're going to have the CDC involved. The CDC is going to package the bank's package. They're going to create their own package, the CDC, send it to SBA for the secondary signature. And so there's a little bit more moving pieces between a 7A and a 504, but the 504 has a much less costly interest rate, which is also typically a fixed rate. So that's the real advantage. That's why we're here today to talk about this product.
Any business owner who has real estate and equipment that if they're financed with a 7A loan, if they're paying over prime plus 2, they've got to seriously think, and if it's variable, they got to seriously think about a 504 loan. And I guess what also factors into that mix is they would have to, investment in the real estate would have to be long-term. Hopefully 10 years, because that's how long the prepays are for the CDC. And for most banks, our bank has a 10-year prepay as well. So, but it's just by far a good move if you have a high margin, high rate 7A that's variable right now.
Perfect. So that's great. So it doesn't hurt if you're in a 7A right now and it's real estate type of 7A. It's good to maybe get an analysis, and guys like Kerry can quickly give you a summary of what that anticipated savings might look like and the advantages of why it would be a good deal or why, maybe it's not the best move for you at the time. But yes, it's an opportune time to fix in your rate, lower your debt payments, increase cash flow, increase profit at the end of the day, increase the bottom line. So Carrie, thank you so much for coming back. I know this was kind of all over the place, but we really wanted to dive in on taking advantage of the refinance option available for people that are in a 7A right now that could be in a variable rate, that it's probably a very good time to fix in before rates move up at some point in the future and potentially be able to take cash out. And on a 7A refinance, I was reading that the cash out portion doesn't get calculated in the 10% benefit. So
that is correct.
So in theory, if you had a ton of equity, you could pull out $500,000. They're not counting that in the 10% improvement in debt payment. So in theory, you could just pull out the cash. They're only looking at debt for debt. So that's an awesome feature too for somebody who's created a lot of equity. A lot of times these business owners go in and then they make the property, improve the property, and we've had great appreciation. So it's a very good time to look at these options and go into a fixed rate. So anyways, hope we answered most of your questions.
Borrowers can also further reduce their monthly payment. And I'm putting a plug for our bank in here because our first liens, we offer up to a 30-year term, where most banks are 20, 25 years. So that's another way to even lower your payment further on the first lien with a 30-year term.
Yeah, anytime you can amortize over a longer period, reduce your payment, your monthly payment. It's kind of a thing we look at all the time in commercial real estate. It's a 20-year AM versus a 30-year AM. Even if the 30-year AM's got a little bit higher interest rate per se, it's still usually a better investment model, like what I'm looking at, because you're getting a better cash flow, and that's usually more important than the actual interest rate. The cash flow is more important. But anyways, Carrie, thank you so much for joining us. We're going to do, every 2 weeks, I've asked Carrie if we could do another topic on SBA.
Thanks for the invite. I always appreciate it. Thank you.
All right.